Coming up on this edition of Perspectives, as the Federal Reserve raises rates to fight decades high inflation, many economists are bracing themselves for a recession. But our investment advisor is here to break down all that you need to know for us. You're watching Perspectives with yours truly, Daren Jaime.
What's on your mind?
Let 'em know.
Express what's on your mind. What's on your mind?
Let 'em know. Anything relevant to life, you bring it to the table. Whether you make a move solo or a movement with a stable. No fables, you speak on your decisions. Cause in the long run, it's your voice, your views, your vision. Keeping it real with many messages for you to know. This ain't radio, but DJ runs the show. Entertainment, he rocks it. Politics, he locks it. The host with the most would handle any topic. Don't forget to share your perspective with shines of light. Cause it might make a difference in someone else's life.
Make a difference in someone's life. Express what's in your heart and your mind. Share your perspective.
And hello, everyone. I'm Daren Jaime, and welcome to another edition of Perspectives. As always, you can watch Perspectives every week here on BronxNet's Channel 67. Now, if you want to stay connected to us also, how do you do that? Well, we can get our social media platform at BronxNet TV. If you're looking to reach me personally, my professional page is Daren C. Jaime on Facebook. And then on Instagram and Twitter, it's DC Jaime 23. And there you can find some information and possibly also some inspiration as well. Well, coming up on our show, we go front and center talking about the economy. In response to higher inflation, the Federal Reserve has raised the federal funds interest rates 5 times since March, and 2 more big increases are anticipated to come by the end of the year. The question is, are we in a recession? And if not, should we expect a recession to be coming in a couple of months? Well, as the stock market continues to go roller coaster in a volatile fashion, how's it going to play out for the average American? Well, we've got CEO and Chief Investment Officer in Orange County Bancorp, Gus Scacco, who joins us now, and he breaks it down for us once again. And Gus, good to have you back.
Hey, Jamie, very good here too. Daren, it's a pleasure to join you.
Thank you. Well, when we look at where we are today, obviously a lot of concern on the part of many people. We can talk about, first of all, the economy. We can talk about federal interest rates raising. We can talk about the stock market going. But when we look at where we are from your perspective, how do you describe it?
Right now, there's a lot of volatility, and that's because of the financial markets themselves. So we've raised rates. The Federal Reserve, the last time we talked about inflation, and the tools that the Federal Reserve have are limited. So what they're doing is raising rates. What does that do? It raises the cost on your credit card. If you're buying a home now, if you bought a home and you were able to pay $2,000, you could have taken out on average about a loan for about $350,000. Now all of a sudden you need to take out a loan for about $6,000. So it changes the dynamic of what people can pay and what the availability is and affordability. And that's really to take down inflation. And inflation, we believe, actually will come down, believe it or not. But lo and behold, that's going to slow the economy because housing, if it slows, which it is doing, there's a painter, there's the person that's the attorney, that's the advertisement that goes into the paper, carpenters. So their housing market only makes up 8% of total gross domestic product, but there's all of these other things that go along with buying a home that help spur the economy. So as that slows, the economy will slow.
Walk me back for a minute because a lot of people want to ask the question, how did we get here? When we talk about the Feds raising interest rates and, possibly 5 times over the course of a year, let's take a look at how we got here. How did we get here?
Well, what happened was when we had COVID, we ended up closing all our supply chains down. So the supply chains are just-in-time inventory. And when you do that, it's not like the internet that you flip a switch and all of a sudden it comes back on. It's a web of different things. So think of the truck you see that delivers, to the department store, which ended up getting goods from a port, which ended up having, come from another country. All of that stuff has to kind of come back together. So just as an example, you couldn't buy a car because supply chains were messed up. There's 30,000 parts in a car. So General Motors doesn't make all those parts. Somebody makes lug nuts for them, somebody makes the engine. You have to get all that stuff together, and you can't lose one of those parts, such as computer chips. Otherwise, you can't produce the car. So all of that has to come together. So that means you have generally less goods to sell, but you have how many people do you know that went out and they wanted to do something or buy something, they couldn't get the items, prices went up. It's too much money chasing too few goods. So that's the long and the short of it. And people were sitting at home not being able to spend their money. Now all of a sudden they have cash and they want to do something with it. That's what pushed up prices.
When you look at where we are right now, people will say that we are in a recession, but some say, no, it's not a recession. Some say a recession is coming. How do you define it?
Well, before I define it, I just want to let you know that consumer confidence is the lowest it's ever been. This is worse than 9/11, worse than when anthrax attacks happened, worse than when the financial crisis happened. If you go out on Saturday night, restaurants are full, people are out and about. Things don't seem that bad, but people feel bad because inflation, prices are going higher, and their salaries are pretty much locked and staying the same. So until inflation comes down, we're going to have that same type of mood. In terms of the economy, there's something called gross domestic product, and it's actually going to be positive. It's going to be about 2.5% this quarter coming up. The problem that we have is a lot of it's in things that it's shifting. And what do I mean by that? We're going to have a rolling recession. So computer chips, because everyone bought computers about a year or two ago, there's not as much need for them right this second. So there's kind of like it was a pull ahead. So they're going into their own mini recession. But if you're going to travel or go to a restaurant, they're having boom times. So it's going to be a back and forth. And I think it's going to be called a rolling recession in my terminology, that different groups will go through a recession, but overall the economy will be positive. And by the way, one of the other things you have to remember is you don't go into a recession when you have 250,000 jobs being created. So it's kind of an odd point. We're in a position where normally you would cut things and lay people off. You're having some of that, but overall, those people can get hired again. There's 2 jobs available for every 1 person looking for work.
Yeah. I was talking with some friends of mine, and they were saying a couple of things. When it comes to the stock market, they see the stock market is at an all-time low, right? Just about right now. Then you got Apple, and who's been known as their perennial favorite when it comes to stocks, and they had to also receive a little bit of a crash as well. When you look at the barometer of where things are in the market, how do you anticipate the market playing out in all of this?
It's all tied together to where inflation is, because if you look at the way that the markets are made up, you have risk and you have reward. Risk is embedded in the rate of interest that people are paying, right? So as interest rates go higher, the stock market generally will go down. And that's the inverse of what had been happening. So rates had gone higher because of inflation, and that caused the market to go down. Now, the other side of the coin is reward, which is the earnings. Earnings really haven't changed all that much. Usually you see a drop of 20 to 25% in earnings, but we'll find out in the next couple of weeks because it's what's called earnings season. It's a report card. Companies come out and say, this is what we were supposed to do, this is what we did, and this is the reason why there's a difference between what we said and what we did. So right now, there's about $240 for the S&P 500 for next year, and that's what people are focused on. That hasn't changed all that much. And companies have come out like FedEx and said, you know what, our numbers are too high, but that's because of a lot of business that they have overseas, where UPS said actually their numbers are good. So it's 2 companies in the same industry telling you a different story. And don't get me wrong, there's going to be more volatility ahead, and different companies are going to report, different numbers. But when I was saying a rolling recession, there's going to be industry groups that get hurt, and then they're going to come back. We don't have a lot of excesses. In 2008, we actually had too much debt. People are actually sitting on very good balance sheets and limited amounts of debt. We don't have a lot of houses. Whatever's out there has been sold, and you have to basically wait for more homes to be built. And if you're looking at companies and banks, they actually have less debt on their books than they have at any other time in the last 50 years. So if we do have a recession, we're well prepared for it. But I think if there is one, it'll be short in duration, and it won't be that deep. It's just getting inflation out of the picture at this point.
As far as the stock market is concerned, do you think there'll be any recovery before we get to the end of the year? I mean, a lot of people are saying, listen, we just might as well make this year a wash right now.
We always look at things long term. So, between now and the end of the year, I'm not sure. Things don't fit neatly in, months and quarters and years. But all I can tell you is that generally a recession lasts anywhere from 8 to about 16 months historically, where a bull market runs anywhere from 6 to 10 years. So if you have more than 10 years to looking at an investment, and say your 401k plan, you just actually put money, you usually want a dollar cost average. So you're not going to worry and look at your 401k statement. You're just putting money to work. You're investing in businesses. So think of the Starbucks that's on the corner. That's a public company. And I'm not saying to buy it or sell it, but I'm just giving you an example. If you were looking right now, are things, all that bad that you think, Starbucks is worth 25% less than it was a year ago. If they were going to, sell themselves, is it 25% less, or is their business going to maintain and continue to grow? Probably going to maintain and continue to grow. That would get the stock price up over time, and it would be worth more. So we're in the camp that this is something that in a period where, you want a dollar cost average, you want to buy in, and you want to buy companies that are really sustainable and it can grow over time. You want to try to get a rate of return that's going to build over time so that you can retire in comfort.
Yeah. Right now for you, talk to me about, you said that, as far as morale and as far as what we're looking at, it's worse than 9/11, right? And we're seeing that people are really just at a place where emotionally, psychologically, first to deal with this pandemic and then have to deal with now the after effect of the pandemic. If you didn't have to deal with the pandemic front and center the way that a lot of people, that some did, you definitely have to look at it from the way of economics. Talk to me about what you're hearing amongst your colleagues and the people that you deal with in terms of mental, emotional fatigue that's attached to this.
It's been an odd period because, again, when usually you have a bad period, a period that's a recession, it's usually because you have to work off excess. We don't have that. The second thing is inflation affects everybody, and lower income earners is affected more. You're looking at gas prices and food that are both, that food's up about 15% year over year, and gas has come down, but it's still up about 15% from where it was, at the lows. So when we look at those things, it hits you right in the pocketbook. So, that's the reason it affects everybody. But again, once you get past, probably if we look at 12 to 18 months, whenever you have a slowdown in a recessionary type environment, which we potentially could head toward, inflation generally comes out of the system because not as many people are chasing those goods. And by the way, supply chains are actually improving as we speak. So we talked about cars before. There were less than 6 days worth of cars on a lot, say about 9 months ago. Right now, there's 35 days worth of cars. So as you get more supply, as inflation comes down, things will improve. And again, we go through these cycles every, so many years. So if you're looking long term, you're in a good spot if you're going to be purchasing things for the longer term. If you're somebody that needs money in the next 6 months, that's a different story. You want to keep it in the bank. All right.
Yeah. Let me take a quick break and come back. I want to talk to you after the break about Washington and how Washington could or could not have played a part in all of this. We'll talk about that when we return right here on Perspectives with Daren Jaime. And welcome back to Perspectives. Daren Jaime here with you. We're continuing our conversation with Gus Scacco as we're discussing the state of the economy, the recession, where we are in America today. And a lot of people Gus really shaking their heads. I want to talk about a couple of things. Number one, home ownership, because we know that that's been told as the American dream. Generational wealth is established through home ownership. But yet and still, when it comes to where we are today, we are seeing that there isn't enough. You talked about supply and demand. There may be demand, but there's not as much in the area of supply, correct?
That's right. Daren, you end up having about 400,000 homes that are available for sale in the United States. It's normally about 1.4 million. So you have not enough homes. You have a large amount of new families that are being created. And you also have the largest amount of first-time home buyers coming into the market over the next 10 years. So the Fed, by increasing rates the way they did, it was the fastest and hardest that they've ever done this to slow down the economy. But that moved mortgage rates from about a little bit under 3 to now it's around 7%. So if somebody was looking to buy a home, as we said before, it's almost like a third to 50% more to purchase the same home because of the interest rate costs. Why are we different today than we were in the past, and why we're not seeing any type of a housing market that might happen following '08, similar to that, is because there's not as much debt in the system. You end up having an environment where two things. Number one, most people are putting down 20%, and if they're not, they have to buy insurance that backs it up. So if they do default, that there's insurance backing it. The second thing is, you end up having an environment where if somebody were to default in a house, there's someone that's willing to purchase it right after that. The assets are dear. There's not enough homes, like I just said. So you have that. And again, the debt levels people are sitting on are not that big. And on top of that, adding all of this, we talked about the wealth effect. Well, more people have less debt out, but the housing prices have improved. So there's more equity built up in the home for individuals. So they'll probably not, you won't have the same repercussions that we did in '08.
Yeah. You talked about, interest rates and how they are at pretty much the rise has now gone up. You're talking about how we're going to see almost more than 50% more than what we used to pay. The question that somebody may be watching is, so when can we anticipate things getting back to normal, possibly within the housing market?
Okay, normal is a unique word. We're not going to go back to where we were pre-2019. We're probably looking at, we've seen actually, in spite of the pain that inflation inflicts, we've started to see prices go down in terms of input costs. What does that mean? If you're buying lumber, it's almost half of what it was just 6 months ago. If you're looking at sheetrock, all of those things, and you can get those things now. You had to wait. If we were building a building today, if it was a year ago, you had to wait 6 months for sheetrock. You can get in 3 days now, just to give you an idea of the change that we've had. So when all those things are counted in and you look at the prices have come in, we're probably looking at 12 to 18 months down the road where we're going to end up having a lower level of inflation, but it's not going to be 2%. That's where we were. It's probably going to be like 3 or 4%. When you say normal, we're probably going to be in an environment where, if you're looking at mortgage rates, they're going to probably be dropping down to somewhere between 3.5% and say 4.5% or 5% over the longer term. And that's just because inflation's coming down. Yeah. One thing your viewers probably aren't aware of, but the government has pumped in a lot of money into the system, which caused interest rates to go down. They're no longer doing that. They did that to make the economy, stay buoyant during some of the difficulties that we've had over the last, say, 10 years.
Let me be more specific, because we talk about President Biden's rescue plan, right? And we know that money was infused in. So when we look at the Biden rescue plan, a lot of people want to blame Washington and say that it's because of Washington. It did bad for the economy. Some people say it did good for the economy. So level it out for us. Is that what you mean? That
it's good and bad. It's good in the fact that it did help a lot of people, but on the other hand, they're putting money into the economy. So we talked before, too much money chasing too few goods. So you ended up having money getting placed into the system that actually started chasing a limited amount of goods. And that the last time that it was the CARES Act. When that went into place, the economy was starting to move forward, but there was like the insurance of putting more money to work to make sure that we would get liftoff speed. That was the thing that kind of pushed us over the edge to push prices up a little bit. All right. So it's a combination of that and logistics supply chains not being able to function. And that combination is what did it.
So as we look right now, what is your advice to Americans, particularly when it comes to the issue of their money, saving, stockpiling? Back in the days, these people used to put the money under the mattress. What's the advice right now, given the fact that we're in the times that we're in?
Well, you always buy a diversified portfolio. You don't think just 2 months or 3 months. You think, years. So a person that's, say, 40 years old, you probably have 25 more years before you retire. You want to put money to work on your behalf. You put as much as you can in a combination of, stocks and bonds. If you leave the money under the mattress, just think of it this way. If I bought a loaf of bread for $1 and inflation, if I have my money under the mattress and it's not working for me, it's in the bank getting interest, or it's buying, in bonds or stocks, you end up in a year only having about 94 cents. So you can't buy that same loaf of bread. You need more money. So you actually lose money by putting it under the mattress. So you want to keep investing, but you want to have it in a diversified portfolio. Bonds help you in bad times and stocks help you in good times. And that combination over time acts in your best benefit.
Having that combination. And so for yourself, what's it been like for you navigating these times, being an investor and, helping people out and doing the work that you do? Talk to us about what it's been like for you.
I always think of myself kind of as a coach. I was an old baseball player in college. And one of the things that I remember is, coach talking to you and giving you guidance. And we try to do the same thing. We're almost a coach for our clients. So we explain things because a lot of this stuff is very complex, but you can simplify it. So that's number one. Number two is to have a solid plan and move forward with it. And three, sticking with the plan, because people at the worst times are the ones, that's when generally they make a change when they shouldn't.
Yeah. And people do make changes sometimes at the worst time. And I guess you've seen it before where it doesn't seem like it's working. And all of a sudden somebody decides, listen, I'm going to try a new plan. But the fact of the matter is your new plan can really do more damage to the overall plan.
Right. So just for a couple of, saying how complex it is, if the war stops in the Ukraine and Russia, markets would most likely go higher. If you end up having stuff that's happening in Europe stop, you probably would have markets moving higher. And if inflation comes down, you would probably see markets, rebound a little bit. So those are three separate and distinct things. They all can affect the market. It's all intertwined. But if you were looking back 50 years and, you just look back to 2008, if you invested the day before the markets really fell hard and you invested the day before, you actually would double your money by holding till today. So think of it in those terms.
Yeah, that's good. That's a good way to look at it. And that's a good way to leave it, because we got to leave it there. Gus Scacco, it's been a great time, man. Thank you so much for being with us.
Thank you for having me. Pleasure, as always.
And we'll definitely have you back to chair. I'm Daren Jaime. I want to thank you for joining us here on this edition of Perspectives. As we say, pay attention to what's going on, make some wise decisions. And if you don't know what to do, find somebody who has the right perspective to be able to check in with you. If you want to also stay connected to us, the way you go about doing that is hit me up on my personal, Daren C. Jaime, that's on Facebook. And then also DC Jaime 23 on Instagram and Twitter. Until the next time we meet, I'm Daren Jaime saying take care, stay safe, God bless. And most of all, share your perspective with somebody else. It just might make a difference in somebody else's life.